This episode of Macro Mondays aired live at 12:30 p.m. BST on Monday the 21st of October. Tune in Mondays at 12:30 p.m. UK time to watch Macro Mondays live.
Hello and welcome to another Macro Mondays. My name's James Brodie and I'm a Head of Learning and Development here at Onyx Capital Group.
And I'm James Todd, Direct Trader here at Onyx, and I'll be looking to give you insight from our trading floor.
Today we'll be looking at key market charts, risks and trends. We'll be discussing the bond market and how that's giving higher yields now than the equity market for the first time in 22 years. And we'll also look at the much stronger than expected Chinese data that came out at the end of last week, followed up by interest rate cuts this morning.
On the cusp of the US election, we'll be looking at the mixed data coming out of the US as the dollar has also strengthened. We'll be revisiting the gold and silver. We've been seeing these performing quite nicely recently. And we'll also be looking at energy prices and the impact of Middle Eastern tensions on these.
First of all, we'll look at the US data. It wasn't a big week for US data, but what we did see was retail sales coming out slightly stronger than expected. We also saw the Philly Fed manufacturing survey come out stronger than expected. On the flip side, the New York Empire Manufacturing Index came out weaker than expected. We have seen the US dollar rise significantly over the last 2 to 3 weeks, and also US yields. If we look at the data here, you can see that the US 10-year yield has risen and dislocated from the high correlation it's had with the oil price. We had the oil price move significantly lower last week. We'll look at that chart individually later, but the US yields are remaining high with concerns growing around the election and also the budget deficit. Also out the US, we had mortgage applications. Last week, they fell a stunning 17% month on month, and this was on the back of a 5.1% fall the previous month. The 30-year mortgage rate has actually jumped to 7.25%. That's the highest level since July, and this is even with the central bank, the Federal Reserve, cutting rates 50 basis points. So US housing's now reached its most unaffordable level since the mid-1980s, according to the National Association of Realtors.
Yeah, so I think in order to really contextualize this and look at the significance of this data, it's probably worth comparing to the housing market in the UK. So in both the US and the UK, we've seen rate cuts. And in the UK, we saw house prices rise 0.3% month on month in October. And this was building upon a 0.8% rise in September, this data coming from Rightmove. However, in the US, despite the Fed having cut rates, as you said, James, we're seeing these mortgage applications fall. So to see a month-on-month drop in mortgage applications despite lower interest rates, I think that really says something quite significant and quite damning about the underlying demand for housing within the US.
And the fact that the Fed's cut rates, yet the curve has steepened at the back of the curve. We do actually have housing data coming out this week. We have new house sales and existing home sales coming out this week. So that will be one to keep an eye on. Also, as you said at the start, with yields moving higher, bonds are now offering higher yields than stocks the first time in 22 years. Asset managers have their largest long position in over 10 years, and the put-call ratio is now the lowest since March 2022. Again, we've said it before, stocks are expensive, the market is very long, but it's trending higher. You cannot fight the trend.
No, absolutely.
But we must be fairly near a tipping point where we'd see asset managers wanting to take some risk off the table. And we're going to have an interesting 2 to 3 weeks with the elections coming up.
Yeah, definitely. I think the performance of the S&P will be relatively tied to the US presidential election, obviously on the 5th of November. We're going to be talking about this more as the show comes on, but if we were to see a Republican presidency, I would expect the S&P to continue performing. But if people start pricing in a Democratic president next, then perhaps we'll see the S&P start to tick off a bit. But I think that's sort of all very flash in the pan kind of news. And if you look at the trending data as we see here, maybe we're starting to see a bit of a convergence.
Also out, the fact that US posts a 1.8 trillion annual deficit. This is the highest outside of COVID. And one of the reasons we're seeing more interest to sell bonds. Certainly Stanley Druckenmiller, one of the great investors of the last 3 or 4 decades, he's now short, reputedly 15 to 20% of his portfolio is now short of bonds.
Yeah, so this is obviously very significant amount of debt. It's the highest, third highest deficit in history. It's been 23 years since tax revenue exceeded spending. And if you were to, I think it's a bit of a fool's calculation, but simply dividing the interest rate payments by the US population, you're seeing the average US taxpayer having to pay $3,400 or something per person just on servicing that debt on interest payments. So this isn't new. We've been saying for a while that US debt is at unsustainable levels, but this data is just further burying it, isn't it?
And neither candidate seems to really want to aggressively tackle this.
No.
Also, Atlanta Fed Reserve President Raphael Bostic said on Friday, the central bank is in no rush to lower interest rates to a more neutral stance, citing a robust labour market and still declining inflation. There's lots of talk on the street that the Fed's made a policy mistake. If we go back 2 months ago, some were saying they'd made a mistake not going 25 originally. Now they're saying the flip side, there's maybe a policy mistake now that they've gone 50.
Yeah, I think one of the crucial things about this is looking at the validity of the labour market data. And so the previous non-farm payroll data was quite strong. And of course, as a result, the major motivation behind the Fed cutting was to try and tackle this unemployment problem that everyone perceived them to be having. Now, if this most recent non-farm payroll data was correct and isn't going to be revised down, then it's understandable that perhaps they may not want to be cutting interest rates further. What will be interesting to see is if this data stands and if it is revised down or not. It could be within the interests of some to have this data come out as positive before the US election, and therefore I think you could be forgiven for taking everything with a bit of a pinch of salt.
And as we said before as well, the employment data, payroll data doesn't align with what we're seeing from the ISM data.
Yeah.
And also the fact that when unemployment starts going up, it trends. It's very hard to actually turn it around. If we look at China now, China cut its 1 and 5 year loan prime rates by 25 basis points early this morning. And we saw some stronger than expected data coming out last Friday. Q3 GDP grew 4.6%, higher than expected. Expected was 4.5%. But again, this is still a long way below the government's target of 5%. September unemployment rate fell from 5.3 to 5.1%. That's a big move in a month. And again, this won't be in a reaction to the huge stimulus that came out in October. No way that stimulus would be able to take effect in such a short time.
Well, and just on the topic of data validity, James, though, this data coming out of China seems to be very positive, but is it necessarily a strong sign?
I am very skeptical of the data. As we'll see in a second, some more charts that show much more concerning weakness in the economy. I'm also skeptical. I remember back earlier in my career when the Chinese data was coming out, GDP came out at 7.5% every single quarter, and there's no way that was accurate.
Yeah.
But what we did see, retail sales jumped from 2.1% to 3.2%, and industrial output rose from 4.5 to 5.4%. If we look at the data, you can see the CSI 500 index. Well, it had a huge surge when the initial stimulus came out. It's retraced 50% of that. We've had a small rally at the end of last week, but again, this is really hard to trade from these levels because it's just your target or your stop loss is just so far away.
Yeah, it's sort of moved beyond a breakout upwards on the news, and then hard to see any particular trend here. But yeah, I think as we're going to come to look at some of the stimulus measures, things aren't necessarily all that well, and seeing a bit of a downtrend in the Chinese indices, I think would be expected.
So China's house prices in the worst slump on record, that continues. If we look at the data there, prices for second-hand homes are falling in all 70 surveyed cities this year. The government's come out, they've doubled the loans for unfinished properties to $562 billion, desperate attempts to revive the housing market. And the chart that I found the most alarming here, China's total loans of financial institutions plummets. China's credit growth, it continuing to slow. So there's either no demand for loans, or banks won't lend, or more likely both. That chart, it's startling. It's just one direction.
Yeah, absolutely. And, obviously this is exclusively talking about financial institutions, but if you were to extend this tightness on credit into the housing market, it's no wonder that we're seeing these two go hand in hand. If there's a lack of appetite from both, consumers that are looking to take out decent loans to put into housing, and financial institutions, and perhaps a difficulty in getting this credit, it does make sense that all of these are just, toppling off, and it's very worrying for sure.
And we've seen as well, retail investors, with gold moving high, their appetite to invest in gold is taking away from the demand for property.
Definitely. Yeah, I think to build upon some of this poor data from the East, one of the things that was announced, I think I saw it this morning, South Korean exports in October for the last 20 days is down 2.9% year on year. And South Korean imports at the same time over the same period were minus 10.1% year on year. So if you're seeing, South Korean imports and exports both weakening, especially the imports coming off by 10.1%, that's a really significant amount. And I think it probably not, having a worsening of exports, sure, it seems perhaps slightly more marginal. And, that can speak to productivity of the domestic economy, or it can, speak to productivity of international economies. But to see imports falling by 10.1%, that's really damning for local demand. And if you're seeing poor demand out of the East, that has significant impacts, not only upon things like housing and demand for products feeding into GDP, but also for things like oil. If you're seeing such weakening demand, I can see the obvious conclusions drawn that demand for oil-related products is going to be coming off.
Absolutely. Another interesting point. I lived in Asia for 15 years, and when I was trading, and in the times, this was often seen as a leading indicator for the global economy. It's a smaller economy, of course, than the US and the Chinas. It's a very dynamic economy, significant microchip sector. So this was often seen, South Korean economy and South Korean economic data was often seen as a lead indicator for the bigger economies. The ECB cut 25 basis points last week, and we had some dovish rhetoric coming out from President Christine Lagarde saying the economy is somewhat weaker than expected. If we look at the data, you can see euro dollar, we highlighted the double top a few weeks ago at 112. It continues to trend lower. Here, overlaying it with an 8-day simple moving average just to highlight the trend. Seems to be one way at the moment. The US data, the economy it's resilient. We are seeing unemployment creeping higher, but the US data economy is resilient, and Europe is continuing to weaken. CPI came in weaker than expected. French CPI is now down at 1.1% year on year. If we look at Switzerland, not part of the Eurozone, but of course its own independent economy, Switzerland's now in deflation. Producer and import prices are now down 1.3% year on year. What I find interesting there is the overnight index swap is now pricing 75 basis points of cuts in the next year, bringing the base rate down to just 19 basis points. So the market's getting closer and closer now to sniffing negative rates from central banks.
Yeah, I don't think it was any particular surprise to most people that the ECB did cut. When you're looking at manufacturing indices for Europe, Germany and France, we've seen over the previous weeks this data has been poor. If inflation is coming under expectations in some of the major economies, i.e. France, then the government's remit of the central bank's remit trying to keep a 2% inflation target over the entire thing. I think we ought to be anticipating cuts, and particularly, the Eurozone covers a diaspora of economies with different employment patterns, but it's a continual complaint in a lot of these, especially southern European countries, that unemployment is too high. So for the same reasons that the Fed did cut in order to mitigate rising unemployment, it's no surprise that the ECB has cut. And, yet again, this doesn't just stop itself at the gates of the Eurozone, but I think we will probably continue to see this pattern evolving, throughout European-style economies.
And again, it takes me back to the euro dollar, the trade recommendation. If the US is not going to cut as aggressively, but euro area needs to cut perhaps more aggressively, then that says euro dollar goes lower, just one direction.
Absolutely.
Mixed data out of the UK, but bond yields fell and cable fell down to the 1.3% level. Inflation dropped to 1.7% in September from 2.2%, well below the Bank of England's target, but core inflation remains above at 3.2%. Again, that did come in lower than expected. Perhaps the biggest surprise of all was services inflation fell aggressively from 5.6 to 4.9%. So a lot of comfort there for the Bank of England. And it's the first CPI reading below 2% in 41 months. The unemployment rate, though, did tick up. Came down from 4.1% to 4%. So employment came out stronger. And retail sales beat expectations. But a lot of that was put down to computer and technology purchases for back to school and back to university. While if we look at big ticket and luxury items, retail sales here are still at financial crisis levels, really poor.
Yeah, I think also it's worth noting that within the UK, there's a lot of uncertainty within the market. We're on the brink of the 30th of October budget, which I think will be one of the largest changes in policy over, realistically over the past sort of 12 years or so or 14 years since the 2010 Conservative government came in. I think a lot of people are anticipating some relatively significant changes to a variety of taxes and on capital gains tax, for instance. The unemployment data isn't necessarily that disastrous going into it, so that might indicate that they will be less heavy-handed in their approach, and it does seem as though there's a fair amount of disunity within the Labour Party at the moment. So we might actually see a slightly milder budget than some people had been initially speculating. But yeah, it's just worth emphasising that direction on the UK that there's so much uncertainty in there at the moment.
And certainly the 4% unemployment rate is far stronger than what we're seeing in Europe.
Yeah.
But as you've said, the Labour Party is falling rapidly in the polls. So had a disastrous first few months. Moving on to Japan. Japan's exports fall the most since 2021. Looking at the data there, you can see a trend of 9 months of continually strong exports, and suddenly it's turned negative. Maybe this one's a flash in the pan, or maybe the start of a trend, but that'd certainly be concerning. The central bank there has 29 basis points of hikes priced in by the overnight index swap market. But we discussed last week, CPI is now falling and the economy appears to be weakening. Dollar yen back at 149.70.
Yeah, I was just wondering, how much of this speaks to a soft Japanese manufacturing sort of economy versus the currency appreciation that we've seen in Japan. The currency may have had the unintended consequence, I think, of leading to this export decline. So it's significant nonetheless, but it's perhaps worth analysing as to exactly why we're seeing this dramatic fall off in exports.
And one piece of surprisingly strong data that came out last week was Australian employment data came in at 64.1 thousand jobs gained, way above estimates of 25,000 jobs. Aussie yen here now trading at 100. And it's an interesting chart because there was a huge sell-off when we had the yen carry trade being unwound back 3 to 4 months ago. And the technical analysts out there would look at the Fibonacci retracement levels. It retraced to exactly 50% level. Then that is now acting as a support. So it'd be interesting to see here. You typically see Aussie strength from employment data like that. We see Aussie Kiwi, which we've been highlighting recently, trending higher. So here, if anything, Aussie strength and yen weakness off this week's data. But it's in a fairly narrow range at the moment.
And just building upon that, looking at the Australian economy. So the Reserve Bank of Australia Deputy Governor Andrew Hauser, he said that the strong labour market has surprised the central bank, noting supply and demand continue to remain unbalanced. So I think in that scenario, what we've been saying about the Aussie Kiwi trade, New Zealand are probably far more likely to drop interest rates at a more aggressive rate than Australia will do at this moment in time, given the labour market data that we've seen.
In fact, over the next year, Aussie market is pricing 67 basis points of cuts, but New Zealand, is pricing 171 basis points of cuts. There as well, their PMIs recently came in at just 47 in New Zealand. And actually, the overnight index swap market is looking at the chance of a 75 basis point cut at the next meeting. In New Zealand, the meetings, like their data, are much more spread out. So the market is looking that the central bank, the RBNZ, need to be more aggressive and possibly even going 75 basis points. On to the election. Trump's margin has jumped in the election prediction markets. We are just 2 weeks away from the election dates.
Yeah, I mean, coming in, he's coming in with a lot of energy and a lot of momentum into the election. We've been seeing him, he turned up at a McDonald's, I think it was yesterday or over the weekend, showing face and showing willing to the blue market worker, the blue market employee within the US. I think he's doing very well. And what's, quite significant, the most read FT headline of the previous few days has been that in key swing states, so I think it's Pennsylvania, that Elon Musk, obviously, I don't really need to explain who Elon Musk is, but he's offering $1 million per day to random people who have signed up, not only registered to vote, but have signed up to his petition. Now, the petition, the stipulations of it simply say that you are in favor of free speech and you are in favor of, is it the Second Amendment, the right to bear arms?
Yep.
So, it doesn't take too much to read into this and assume that he is offering $1 million per day for people to register to vote Republican in what will be a key swing state. Now, he is coming under scrutiny. I'm not sure whether it's necessarily illegal. It certainly borders on the ethical side of things, but it's going to be crucial to see that these key swing states will, as things stand, I think there's a good chance that Trump is going to get in. Kamala, seeing how she was doing so well, and in fact, I think both leading in polls and leading in betting markets only, a month
just
or
2
two
weeks ago.
Yeah. And to see this swinging momentum coming into it, it's I'm slightly surprised, to be honest. But what's the impact of this upon the macroeconomy? Well, we continue to see the S&P doing well. We're going to come on to talk about energy prices, but if we would see a second Trump presidency, I think that would have a dramatic impact upon the price of crude oil compared to a Kamala Harris presidency.
Yeah, the market's saying with Trump coming in, yields are going higher and the dollar's going higher. In fact, the dollar's the most overbought since 2022. And back to Europe, just some headlines about debt, France and Italy. France gets another debt warning, while Italy gets a Fitch boost on outlook as debt's raised to positive. Interesting data we look out here. Again, something we've highlighted is just how far the euro area is lagging behind the United States. The United States, much more dynamic economy, and euro areas just seems to be suffocated by regulation at the moment.
And then, so now just to talk about oil a little bit, what we've been seeing over the past week is this upward momentum that had been seemingly caused by the war, not out and out war, but by the ongoing conflicts in the Middle East. We've seen those gains sort of wiped out a bit, and crude seems very range bound. If you look at the Brent futures price, it's come off overall over the week, and I think it's really struggling for upward momentum here. If you were to look at the exogenous factors that could cause strength in Brent at the moment, you look at Russia-Ukraine, you look at the ongoing Israel-Palestine, Israel-Lebanon, Israel-Iran situation. Those two major conflicts, I don't think are producing the headlines required for upward momentum in Brent at the moment. It sounds as though Netanyahu is going to be looking at the Iranian military sites, not nuclear or not oil sites. So that wouldn't have an upward impact upon the Brent price. And then if you look at the other source of supplies, so if you were to look at if you look at Saudi Arabia, if you look at OPEC, they're already announcing effectively cuts. They're already prolonging their periods of reduced production. So it's unlikely that they're going to be able to cut that much further. All they can really do is extend cuts. And then if you were to look at, as we just mentioned, the US, if Trump comes in, I think the rhetoric, drill baby drill, it's
as much as you can.
Yeah, it's synonymous with the Trump election at the moment. So there are a lot of things that are conspiring to keep a lid on Brent prices. And if you look at the underlying demand, it's looking weak. We're not seeing demand out of the East be significant, and the South Korean and the Chinese data looks poor. And then looking across Europe and the US, there's nothing macro-wise that's pointing to a huge rise in demand for oil-related products, and particularly as there's more and more policy and slow transition towards cleaner energy. The rhetoric around oil at the moment is I don't think it should be particularly supportive. Yet again, though, you do occasionally get the headlines and the analysts saying crude needs to be at $100 per barrel, and they'll list whatever they can pluck out of thin air to try and support their view, but it doesn't seem that strong.
Yeah, what I found interesting last week with a headline, it came out Monday night, I think. All the headlines from the Middle East tend to be bullish, but the headline came out that Israel doesn't plan to strike Iran oil or nuclear targets. And that was the first dovish headline I'd seen, and the market fell about 4% in 2 days.
Yeah.
And again, if we look at the data, you can see the chart, it's in a narrowing wedge. And what typically happens, we thought the last few weeks have been volatile, but looking at the bigger picture, it's very low volatility looking at it historically. And the market's waiting really to break one way or other. But if anything now, as tensions ease in the Middle East, it looks like the bigger picture becomes a global macro story of weaker demand than expected. So again, the 70.5 support level suddenly becomes a target again.
Yeah. And then, just sort of building upon what we've seen in oil, looking at European energy, if we look at the data, we can see that it was a relatively strong performance in the week going up to the 14th of October, but we've seen some of these, some of this strength wiped out over the previous week. I think our view here is very much, energy power should be tied to European performance, and having seen what we've seen in France, ECB being forced to cut in order to keep things alive in Europe, I don't see any particular reason why power should be supported. We've seen a slight downtick over the past week, and anticipating this downtrend to continue with continued weak European performance.
With the OAS, really the big moves in the OAS market is the market's pricing more aggressive cuts, certainly from the Bank of England and also the ECB. Moving on to some interesting charts. We mentioned at the start, silver has had a huge breakout, was up over 6% on Friday, up another 1% this morning. It's now at its highest level in 12 years, and gold breaking all-time highs as well.
Yeah, I mean, on the topic of gold, we're hopefully, well, not hopefully necessarily, but we look as though we're going to be going into a low rate environment. Low rates traditionally good for gold performance, and then you're probably going to be seeing quite a lot of money flowing into gold as people look to hedge US elections. And even though we're not seeing particular headlines escalating crude prices based on geopolitical uncertainty, ongoing geopolitical uncertainty, I think is probably going to be supportive to gold here. So yeah, we're very much seeing these support levels continue, and the momentum is just carrying on, isn't it?
Absolutely. And if we look at that, looking at the data, this is a classic example of a breakout trade here on silver. And actually, if you go all the way back to, I think it was January or February, my first time on the world of oil derivatives, we discussed gold at the time was trading at 2000, just below 2080 level. We said when that broke, that had been a quadruple top. It'd been the peak 4 times over the previous 18 months. A break above that, you get new buying coming into the market. You can see with silver, a break above multiple highs and a breakout to new highs, typically where you get new buying coming in. If you study famous traders like Darvas or the turtle traders, you know that this is a common strategy used in equities as well. And again, a 6% move on a day is huge. The Bitcoin chart, well, Bitcoin is trending higher, but that's not making new all-time highs yet. So there's still resistance at 71,800 and really the peak 73,800. The short-term trend is up, but it needs to close above 73,800 to really get strong investment coming into the market.
Yeah, I think with Bitcoin, the two obvious macroeconomic things to look at are the US presidential election and low interest rates. It sounds like we're sort of flogging a dead horse at this point, but yeah, I think the general consensus is that a Trump presidency is good for crypto, and so as the likelihood of him being re-elected continues to raise, we will not be seeing Bitcoin undermined at the very least until it sort of reaches its target and decides whether it wants to break all-time highs. And yeah, low interest rates, people look to speculate, don't they?
I also think another attractiveness of the precious metals and Bitcoin is the fact that equities it's such a crowded trade and they're all-time highs. It's another alternative, and we may see a lot of volatility in equities going into the election as well. So central bank buying, precious metals, of course, and also retail traders in China. We know they're going into it aggressively. Polish central bank, Chinese central bank, although they've been buying less in the last 4 to 5 months. But the more it goes up, the more attention it gets. If you look at all the other previous moves in the likes of Nvidia, Tesla.
Yeah. Fear of missing out.
Absolutely. Talking of Nvidia, interesting point there is looking at the data, the chart. It's a perfect double top here. Investors will buy if it closes above $140.76. That's the previous peak. We had a sell-off. We had some profit taking there. Some losses would have been taken there. It was a very crowded trade, but it's now looking to break higher again. Purely technical trade. If it closes above 140.76, then we'll see new buyers coming in with a stop loss just below that level. And a chart of the week, we've had this before, the 2-year yield. This is interesting because it's in such a narrow range at the moment. The last 2 to 3 weeks, it's been with a range of 4% to 3.92. And you can see it's got a resistance level coming, a resistance line coming down across the top of it. Again, a break above 4% would be buying, a break below 3.92 selling. And again, there's different macro reasons behind this as well. If the global economy is starting to slow, or the US economy, we see further weakness, then you'd see buying of bonds and yields lower. But the flip side, we've discussed earlier the problems with the US budget deficit, the lack of the Democrats or Republicans to want to cut spending, and famous investors like Stanley Druckenmiller shorting bonds. You can see there's a lot of appetite to short as well. I would typically on that trade the breakout of that narrow range. Which brings us on to this week's data. We have 15% of S&P companies reporting this week. It is pretty quiet on the data front. On Wednesday, existing home sales, that's pretty much secondary data. Thursday, US and Europe manufacturing and services, just the flash PMIs. New home sales, jobless claims and durable good orders. And Friday, consumer sentiment. So fairly light on the data this week, but we'll see lots of price action, especially as we head in towards the November 5th election. That's all for this week. Hopefully you've enjoyed it. Don't forget to like and subscribe, and we'll see you next week on Macro Monday. Thank you very much.
Thank you.